Hey everyone, Lee Kevin here. You've got to know this information before Friday because it could dramatically affect your investments, specifically options. If you're in on options, you're going to want to pay attention to this, but it could also affect your stocks. We've got a big catalyst coming up on Friday, and we've got to talk about it. Folks, it's the monthly jobs report, and this one is potentially more critical than any of those before it because this is potentially the start of an inflection point one way or the other. We gotta know what to expect. Now, you may have heard some potential clickbait about jobs today. Jobs report for June doesn't actually come out until July 2nd, which is Friday morning at 5:30 a.m. California time, 8:30 Eastern time, which I will be up for. I will be live streaming that. I will just have returned from Florida because I am heading to Florida to be on Valuetainment's podcast tomorrow, which is super exciting, so make sure to tune in for that. At the same time, I would ordinarily have the market open live stream. I'll be at Valuetainment's podcast, so check that out if you want to join. Also, I will be holding rallies this weekend for my campaign. Go to meetkevin.com to see the rally locations. Got 3 this weekend and 5 next weekend and more coming thereafter. Okay, so the clickbait you may have seen this morning has to do with a private estimate by the ADP. This is an agency that tries to do a rough estimate of how many jobs they think our economy added in June. And their report is that we may have added, wrong screen, how about that one? We may have added 692,000 jobs in June, which hopefully all of these people adding jobs are signing up with the 40% off coupon code down below for the amazing programs on Building Your Wealth, which does expire today, so take advantage of that. But anyway, there's a problem with this report. This report sounds great. Their press release comes out, hey, private sector employment increased 692,000 jobs from May to June, according to their unemployment, or their employment report, I should say. Hey, that's wonderful. They break down these different sectors here. Small business, medium business, large business. Great, everybody's somewhat adding equally. Service providing up 624,000 out of the whole chunk here. Great. Problem is, even though this number is higher than expected for the ADP report, the May total of jobs added was revised from 978,000 to 886,000. So it's kind of like they gave us a beat, but then in the details, which remember the devil's is always in the details, they actually revised down the amount of jobs they think were added in May by a count of here, what is that, 90,000, 92,000 jobs. So it's kind of lame, a little bit clickbaity. So what do we actually want to pay attention to? Well, we want to pay attention to the real jobs report this Friday. And here are the expectations. So here we go. In April, we expected 1 million jobs to be added. We only added 266,000 jobs in April. That was such a big miss, the market freaked out a little bit. And we ended up with a pretty ugly May for a lot of stocks. A lot of companies didn't do great in May. With, of course, the exception of index funds, they just continue to do well. But I think that those days are numbered and we're flattening over in the index funds. We're gonna get inter-rotations, but that's more for a different video. In May, we saw the expected numbers at 675,000 jobs. And we also missed, coming in at 559,000, though not as much of a disappointment. It just means we're adding jobs slower than expected, and adding jobs slower than expected is kind of normal when people are looking for different jobs. They're looking for new jobs. Yesterday we talked about how more people are likely to quit their jobs or just retrain and get a totally new job than they are to stick with their current job because COVID has changed so much about the way we live, where we live, and the way we work and what we work on and what we enjoy and what we don't enjoy. And so that's being reflected in the slower growth in employment numbers. Now, for June, we're presently expecting 711,000 jobs to come in. You saw the ADP report, they're estimating about 692,000. The expectation is 711 is what we're looking for. So remember, 711. Now, my estimation is that we're going to hit somewhere between 550,000 and 800,000. And here's how I think the market is going to respond if we get these different hits. So first, in the middle here, we have 711. You can see I'm slightly biasing to the downside though, because I believe that the downside is a little bit more likely than I believe us beating substantially as likely. I think it's going to take a lot longer for us to get to lower unemployment rates, which means more employment, right? I think that's going to take more time. So that's why I have this range here. If we hit the number, or really we hit anything between here, I think mostly the market reaction is going to be pretty neutral. It's going to be pretty bland, pretty meh. Now, the reason this range is tighter though, is because if we get a number over 800,000, I personally think the market's going to get a little bit of heartburn. They just ate a little bit too much too fast, got too many jumps too fast, and the market a little bit is probably going to send the 10-year treasury up, which that's going to weigh down on tech, but it could actually be a good leading indicator for recovery earnings, which today is the last day of the quarter. So obviously we're expecting this quarter to end out, then we're going to start getting earnings, and this could potentially be a leading indicator. Sorry, this should not be a down arrow for recovery, it should be an up arrow. This could be a leading indicator for strength in the recovery sector if all of a sudden the services industry in the recovery sector is adding jobs like crazy and way more than expected. Then I would expect recovery stocks to pop up nicely, because it's a clear indication that if businesses are hiring a ton, they've got lots of demand at their businesses and they see that demand sustaining. So I think that could be really good for recovery. It's going to be a little harder on higher value tech or consumer discretionaries like the Etsy's that are a little bit more up there on the PEs. The recoveries, even though we've got some higher debt, a lot of these companies have done very, very well. I think personally they're fully valued, but on a surprise beat, I think they could do well. Now, this is an earnings, it's kind of like an earnings day when you get the unemployment report. So generally it's a day that after this day, you end up seeing implied volatility on options go down. So you could see on this particular day, if your contracts go big green here, there could be an opportunity to take some tendies, take some profits, and rotate into some new options or whatever, or even wait a few days to do that. Obviously, no guarantees. Well, if you lose money, it's your fault. Don't sue me, bro. I'm drinking, what do I got today? I've got the 99 Slayer mug and a pink straw. Now, people get confused when I have the straw, and stick around because we got to talk about the downside. People get confused when I talk about the straw because they're like, why is there a straw in your coffee? I don't put it in when it's scalding hot. I sip my coffee when it's scalding hot. When it gets cold, I use a straw. Okay, so what if we miss to the downside? Well, the good news is, well, you could at least today still use the 40% off coupon code for the amazing programs linked down below, which does expire today. But if we go miss to the downside, okay. So this gets interesting, okay? So it's not as clear and cut and dry, I think. See, I think you actually have another potential range here. I think if we're somewhere between like 300K to 500K, this is a miss, but this is potentially going to lead the 10-year to go down, 10-year treasuries down. That means we might even see, depending on how much, we could see the 10-year go down to 1.35 plus or minus somewhere in that range. We could see tech and consumer discretionaries actually do well, and I think recoveries will suffer in this. Now, there is a problem here though, because if you undershoot even more and you go under 300K, you could end up leading into kind of like a May where all of a sudden it's like, wait a minute, this could be so anemic growth that really you start fanning the fears or whatever of stagflation. So you really want to stay away from the low level. So as with everything in investing, there's a whole lot more nuance to it's just this or it's just that. These are some expectations. Now, what do I think is the most likely? Well, if I were to draw the most likely here, I'd probably say most likely would be somewhere in the range here of 625 to 675. That's probably the most likely range, followed by, if I were to do another likely range, I'd probably be like 575 to 750, something like that. That would be like my second most likely range, something of that effect. So I'm not really expecting craziness to the left or right, but when that report comes out, if it's a big miss over here, that could be painful for everything. Potentially painful for everything. The reason, by the way, we think that tech and consumer discretionaries go up and the 10-year goes down is because this means there's lower risk of interest rates going up. So it's a lower interest rate risk. And if we get an overshoot, we're overheating, this increases the odds of rates going up sooner. So it gives you a little bit of an explanation there. All right, folks, there you have it. Check out the coupon code down below. If any of this talk about finances stresses you out, go to metkevin.com/life or metkevin.com/lemonade and get life insurance in as little as 5 minutes. Check out both of those, metkevin.com/life, metkevin.com/lemonade. You can also get homeowners insurance, renters insurance, and pet insurance at Lemonade, metkevin.com/lemonade. Thank you so much for watching, folks. See you in the next one.